Can an 80-year-old IT giant actually reinvent itself in the age of AI? Honestly, that is the multi-billion-dollar question hovering over Wipro right now. We're talking about a legacy Indian IT powerhouse here. Are they really ready to pull off a massive structural turnaround in this hyper-competitive AI era? Or are they just going to keep lagging behind the pack? Let's find out.
Welcome to This Explainer. Today, we're unpacking a seriously fascinating corporate pivot. We are diving deep into the Wipro Transformation, looking at their massive strategic bets, the fresh leadership under CEO Srini Pallia, and of course, the hard financial realities of their recent quarters.
Here's our roadmap for today. First, the Wipro Transformation. Second, their AI-first playbook. Third, the financial scorecard. 4, deals and restructuring. And finally, number 5, risks and roadblocks.
All right, let's jump straight into Section 1, the Wipro Transformation from sunflower oil to AI powerhouse.
Now, to truly get where Wipro is heading, we kind of have to appreciate where they came from. And guys, it is a wild ride. Founded way back in 1945, they actually started out manufacturing sunflower oil and laundry soap. I mean, talk about a pivot, right? It wasn't until the tech boom of the 1990s that they successfully morphed into a global IT services powerhouse. Fast forward to April 2024, and a brand new chapter kicks off, the Pallia era. This marks a very deliberate shift toward an AI-led delivery model to essentially reclaim their throne.
And when you look at the last 5 years, this leadership change was absolutely necessary. Frankly, Wipro has struggled. They've dealt with leadership churn, serious cultural friction from a bunch of acquisitions, and growth that just consistently trailed Tier 1 rivals like TCS and Infosys. But look at this 2026 shift. Under Sri Jaholia, who's a 30-year Wipro veteran, by the way, they're projecting stabilized leadership, moving to a leaner, consulting-led model, and injecting some major investments into AI. They are aggressively trying to leave that past turbulence in the rearview mirror.
Which brings us to Section 2, the AI-first playbook. Wipro AI 360 and the innovation moat.
$1 billion. That single number is literally the anchor of their entire strategy right now. Over a 3-year timeline, Wipro is committing a cool $1 billion to advance its AI capabilities, set up robust AI governance, and scale enterprise AI deployments. They are essentially betting the house on moving away from standard linear software coding and diving headfirst into platform-driven modernization. Now, I know it's super easy for companies to just throw around AI buzzwords, but what's really interesting here is exactly where Wipro's money is going. We're seeing actual, tangible outputs. They've already upskilled 225,000 employees in basic Gen AI concepts. Think about that scale. Plus, another 30,000 are trained in advanced application development. They've also fully operationalized their proprietary Lab 45 AI platform, securing over 470 patents, and even cranking out autonomous, agentic AI solutions. They're even partnering up with the Indian Institute of Science to offer advanced degrees for their workforce. So the takeaway here? They aren't just drafting flashy press releases, they're actively building a real innovation moat.
Let's move on to Section 3, the financial scorecard, Q1 FY27 and full year FY26 reality check.
Okay, let's peel back the curtain and look at the hard financial data. Is this turnaround strategy actually working? Well, looking at their Q1 FY27 results, analysts are calling it a bit of a mixed bag. On the top line, things look fantastic. Gross revenue hit 24,478.60 crore rupees. That's up nearly 10.6% year over year. Double-digit rupee revenue growth is nothing to sneeze at. But then you look at the net income. It's practically flat, up just a tiny 0.59% to 3,356.30 crore rupees. And honestly, the most concerning metric? Their IT services operating margin, which is essentially their core profitability, hit a 15-quarter low of exactly 16%. It's getting squeezed heavily by wage hikes and the massive costs of ramping up all these new deals.
When we zoom out and look at the full-year FY26 scorecard, a real structural challenge becomes pretty obvious. Overall, gross revenue rose 4% to 926.2 billion rupees. Great. But their core engine, the IT services revenue, which we measure in US dollars, actually declined slightly by 0.3%, down to $10.48 billion. If you're watching their stock, this paints a picture of a company that's stabilizing, sure, but one that is really struggling to find consistent organic growth in its most vital sector, while clients are still being super cautious with their spending.
And to be fair, CEO Srini Pallia isn't hiding from this. He acknowledges this shifting landscape head-on.
He noted that advancements in AI are completely reshaping client priorities. So, his response? He's pivoting Wipro to a services as a software model through their brand new AI-native business and platforms unit. It's a fundamental shift in how they actually plan to monetize their services going forward, a real game changer if they pull it off.
Which takes us to Section 4, Deals and Restructuring, Realigning for Agile Delivery.
So how exactly does this build out operationally? Well, to land these massive new AI-driven contracts, Wipro pulled the trigger on a major internal reorganization back in April 2025. They totally simplified their delivery into 4 agile, output-focused global business lines. First up, technology services, covering cloud and cyber. Second, business process services, where they are really leaning into hyper-automation to cut down on manual work. Third, consulting services. This one is absolutely crucial because their premium Capco subsidiary sits here, letting them talk strategy right in the boardroom. And finally, number 4, engineering, handling all the R&D and hardware.
The big question, is this new structure actually paying off? Well, the immediate data says yes. In Q1 FY27 alone, Wipro secured a staggering $1.63 billion in large deal bookings across 13 major contracts. This is a massive green shoot for the company, guys. They are successfully closing huge digital transformation, cloud optimization, and AI deployment contracts with some of the biggest global healthcare, retail, and financial institutions out there.
And let me tell you, management is highly incentivized to keep this momentum rolling. CEO Srini Pallia's compensation for FY26 was $5.29 million, or roughly 49.6 crore rupees. But here's the kicker. His pay is intensely tied to operational outcomes like revenue growth and EBIT margins. When you stack his paycheck up against his peers, well, the TCS CEO earns around 28 crore rupees, and the Infosys CEO is pulling in roughly 82.6 crore. So Pallia sits comfortably right in the middle. His pay is directly aligned with the heavy lifting required to actually execute this turnaround. No free rides here.
Moving to our final part, Section 5. Risks and roadblocks, headwinds in a competitive market.
Look, we have to be objective here and look at the severe structural risks that could absolutely derail Wipro's momentum. First, there's discretionary spend weakness. Corporate tech budgets, especially in U.S. banking and insurance, remain incredibly tight right now. That delays turning those big flashy deal bookings into actual revenue. Second, as we touched on earlier, margin headwinds. Wage hikes and project transition costs are keeping profitability at those 15-quarter lows. And third, this one is a massive external threat. There are proposed $100,000 fee hikes for U.S. H-1B work visas. If that goes through, it could cost Wipro hundreds of millions and severely damage margins in their biggest market. No way around it, that's a huge hurdle.
So, to combat these intense pressures, Wipro is making some ruthless structural changes. Get this, they slashed their FY26 fresher hiring target, meaning new college grads, down to just 7,500 to 8,000 recruits. Now, don't mistake this for just standard corporate belt-tightening. This represents a deliberate, fundamental shift. They are moving away from the old-school IT model where you just linearly throw bodies at a problem, and instead they're pivoting aggressively toward a productivity-driven, asset-light delivery model powered by, you guessed it, automation and AI.
Ultimately, the market is still tapping its foot, demanding proof that this transformation is sustainable. Right now, Wipro trades at a forward price-to-earnings ratio of roughly 18x. That's basically a metric showing what investors are willing to pay for future growth. Compare that 18x to rivals like TCS and Infosys, who are comfortably cruising in the 24x to 28x range. That massive valuation discount? That's the market literally pricing in the execution risk. Investors see the billion-dollar AI bets, they see the large deal bookings, sure, but they are stubbornly waiting for all of it to translate into consistent quarter-over-quarter top-line acceleration.
Which leaves us with a pretty compelling dilemma, drawn straight from the latest analyst reports. Wipro has undoubtedly stabilized its foundation under Srini Pallia, but let's be real, it hasn't fully ignited its engines just yet. So I leave you with this question to ponder, based on everything we've explored today. Is Wipro a classic value play in the making for those with a long-term horizon? Or, in this cutthroat AI era, should you just stay on the sidelines and wait for a definitive buy signal? It's a completely fascinating corporate story, and we'll definitely be watching it unfold. Thanks so much for exploring it with me today on this Explainer. Catch you next time.